Greetings and welcome to the November edition of our monthly webinar series. Today we are going to be addressing the topic of navigating non-qualified retirement plans. My name is Kristen Kolish, a retirement plan advisor at Raymond James. And by way of background, I work with both employers and employees to help navigate retirement and other financial goals and objectives. And we do that through the lens of an employer-sponsored savings plan. So it could be a 401k, 403b, pension, and of course today's topic, which is non-qualified deferred compensation plans. I am thrilled to be joined by my colleague, Christine Lampert, our executive benefits specialist and guru at Raymond James. Christine consults with organizations to assist in helping them attract, retain, and reward employees to ensure organizational success. And she excels at working with organizations to translate their objectives for their non-qualified plans into a reality. So today she's going to share her insights on, from a technical perspective, on what is allowed, what is possible, dream big. This is a little different than our qualified plan space, which some of you may live in for part of your day. And I'll here and there sprinkle in some practical applications that we see with our mutual clients. But before I turn it over to Christine, let me first cover some logistics. We will be sharing the slides, so you can expect to receive that in an email along with the PDC code for those of you joining who are interested in getting 1 hour of credit through the Society for Human Resource Management. So I'd encourage you to sit back, listen, and take in this valuable content, knowing that you'll have access to the information. And today's program is really meant to be non-qualified plans 101, as we were joking as we're preparing for this session. We intend to cover the basics, but we're also going to talk about how we see these plans being used in today's marketplace. So even if the rules have stayed the same, we know that employment dynamics have changed, and maybe the things that our workforce is looking for is evolving. A theme that I hear from clients all the time is that employees are expecting more from their employer. So how can perhaps the tools that we're going to talk about today bridge that need? I can appreciate that as attendees, you all have a wide range of different experiences. Something captivated your interest with this invitation. Perhaps you're considering adding a plan to your organization and you don't have one in place. Maybe you came from in your prior life, you had this plan, a non-qualified plan, you don't have it today. Or maybe your organization already has a program and you're just wanting to learn if you're optimizing that benefit. For all of the above, we hope to provide some value today. There is an opportunity, if you have questions, throw it into the Q&A box at the bottom, and I'll make sure that Christine and I cover it during the course of the discussion today. So with that, Christine, take it away.
Thank you. Hello, everybody. Good afternoon. Good morning. So let's get into navigating non-qualified plans. I'm opening with a study, a survey from Plan Sponsor Council of America, looking at how companies are using non-qualified plans. When we think about a non-qualified plan, it started as a result of legislative limits on qualified retirement plans. And historically, they started with large public Fortune 100, 200 companies. And today, non-qualified plans, and they have been for a while now, utilized at the public and the private level, because private companies have the same needs that the public companies have: attract, retain, reward their employees. So this is the results of the survey 2023 from Plan Sponsor Council of America, and their survey respondents indicated that 80% of companies in the survey are offering a non-qualified plan to offer a competitive benefits package, looking at all the tools they have in their compensation toolbox and utilizing it as part of that program, that compensation package, to be competitive and able to attract talent, their key employees. And 61% are offering it to be able to help them accumulate wealth, offering an opportunity, an additional opportunity to accumulate, to be retiring when they choose to retire. And 56% are utilizing them to retain key employees. I'm actually a little surprised that this came in third because for the past year and a half or 2 years, most of my conversation has been based around how can we retain our key talent to our organization, especially coming out of the pandemic, and we live in such a mobile, work from home world that we live in today. But those are the top 3 areas that we're seeing that the reasons for companies are implementing non-qualified plans or revamping them if they have them and redesigning them. Some outcomes for non-qualified plans for plan participants, why they would want to participate in a plan. It's the tax efficiency, really. They have the opportunity to defer in addition to any qualified plan offered on a pre-tax basis. Those deferrals will accumulate on a tax deferred growth basis, similar to the qualified plan. And they have distribution flexibility. And by that, I mean more flexibility than the qualified plan. If they want to take out money while they're still working for financial planning purposes, et cetera, whether they take it out as a lump sum or over periods of time, but they're able to really utilize a non-qualified plan and all the features of it to kind of tailor it to their personal financial planning situation, which can be very helpful for them. From a plan sponsor perspective, well, it helps with all the R's, right? So it could be something as simple as offering a tool to satisfy beyond the 401k. Again, allowing them to defer that compensation pre-tax in addition to the limits placed with the qualified plan. To me, the important one, mitigating cost of key talent, right? Replacing key talent, allowing to put some glue in the seat there to hold them, to help continuing have a successful organization and helping with the growth of the organization. And allowing employers the flexibility of who do we want to participate in this plan and how do we want to design it to be aligned with our corporate goals and support our corporate compensation philosophy. I think that for a lot of private organizations, a lot of the bandwidth with human resources is spent on the health insurance program, the health insurance benefit for good reason, and the 401k, right? Broadband plans that everybody participates in. Sometimes it's hard to remember, or sometimes private organizations aren't aware that they can be selective and dedicate plans just to a small group. And with a non-qualified plan, we must dedicate it to a small group, right? A non-qualified plan is for a select group of management and or highly compensated employees. So if we're looking at something to really drive that key employee talent, we can focus on that group, and we can use discretionary company contributions focused on that limited group to be able to obtain, whatever the objective is, attract, retain, reward, or a few of them, et cetera.
It's funny, Christine, right? I think about if you spend a lot of time in the qualified plan space, and we promise this to be a 101 session. So what's qualified? Qualified means it's covered by ERISA, the Employee Retirement Income Security Act. Non-qualified plans are not, which means this is going to sound very not PC from an HR perspective. You can discriminate, right? Meaning like you can choose who you want to reward. And it could be as simple as allowing a group of employees to defer more of their income, or you can also introduce employer contributions as well. So I think that's just so interesting. And it's a great reminder, Christine, that you're sharing with our attendees is that unlike your 401k or your 403bs, where plan design is very regimented and you have limited options, with non-qualified plans, it's almost as if you're starting with a blank slate.
You have a lot of flexibility and customization. In my world, we always say, if you've seen a company with one plan, you've seen one plan, because plan design can be very different company to company, because their goals and objectives are different often, and what they're trying to do, who they're trying to reward.
I love the engagement already from participants. We do have a question on this topic. I'm going to just address it here. What is considered highly qualified? So qualified is not intended to be a positive or negative descriptor. Qualified means that it is considered by the IRS and the Department of Labor to meet certain provisions to allow an employee to defer income. And qualified plans are 401k, 403b, and pensions. As it relates to non-qualified plans, Christine, can you talk about, is there a maximum or minimum percentage of the employee population that would have to be allowed in this group?
Yeah, that's a great question. So for a non-qualified plan, we're generally looking at a limited population, and it's usually about 10 or 15% of the total employee population. You can go a little bit higher on occasion, but usually we try to live within that window. The Department of Labor has what we call gray areas. So when we're looking at who is eligible, we're focusing on what is their job, are they in management, and we don't strictly just look at compensation, because somebody living in New York City is going to be earning a different compensation than somebody in Iowa. So usually we're looking at a couple of things to determine, are they eligible to participate in a plan? And it's a conversation we have with, clients. And also we're looking at, it could be and or highly compensated. So maybe you have some commission salespeople or salespeople who are not in management, but, commanding, a good compensation through their job. So for that, again, it's a little bit geography based. So maybe we're looking, what's the definition of highly compensated? I also sometimes will see whether it might go a little bit lower than what we would look at for that. But usually 6 figures anyway. Somebody earning 75,000 is somebody who can max out in the qualified plan and really take advantage of that. Somebody who's earning, 150, 200,000 can't generally. So there's just a few factors that we look at there, not just one specifically. Great question. We like to say that non-qualified plans can be utilized to recruit to retire, because it can solve all of the R's. And sometimes companies are interested in all of these, or sometimes it may be an M, motivate, but other times it might be a few. So I might hear from clients, we're having a really hard time recruiting. I do actually hear that quite a bit. We're having a hard time recruiting. What can we do to be able to recruit people and have them stay at the organization? So, and usually there's a little reward or retention. If you're trying to get them here and it's an effort, you want to be able to retain them too. So usually there is a couple, but you can use a non-qualified plan to be able to supplement your compensation philosophy and really hire them and be able to keep them to retirement, if that's your interest, to be able to do that. I think that we see the companies are with the struggle and with the legislative limits on the 401k plan. We see that today, and we hear certainly through the election, I think we heard a lot about it, of people being able to accumulate wealth, right? The struggle is real for a lot of people. So, we see that a lot of people aren't retiring at the age they would like to, because they don't feel they have accumulated enough to be able to provide for themselves in their retirement years. And it's a little bit of a double-edged sword in that we have the employee who would like to retire and can't afford to, but it also impacts the organization in that there's a cost to them for that employee not being able to retire. So benefits are more expensive. They're not able to hire somebody at a younger salary. So there is, and studies do indicate that there is a quantifiable cost for people who are doing a delayed retirement. Kristen, did you want to add any commentary to this slide?
Absolutely. It's a theme that Christine, you and I talk about often. It actually came up in a webinar that we hosted over the summer on the topic of managing benefits for 5 generations in the workforce. And it's how do you customize your benefits to meet the evolving needs of a very diverse workforce? And one of the interesting takeaways from that session was you could have the reverse problem where you risk brain drain, where your key talent, it actually is a detriment to the organization for them to be retiring early. So the non-qualified plan not only supports a healthy retirement lifestyle, but it also gives you some important carrots to encourage those that you want to stay to, in fact, stay.
This is an illustration of the retirement savings gap. And, we like everybody always say that the qualified retirement plan should be your first line of defense. And we always are trying to encourage people to participate, to accumulate wealth, to be able to finance themselves in their retirement years. So what this is really illustrating is that at 150,000 of income, you are not really able, between what may be in your qualified plan balance and your Social Security anticipated retirement benefits, not able to hit that income replacement goal. And so studies have consistently said in recent years that income replacement goal should be about 80 or 85% of our pre-retirement income. So lower paid people are able to really accomplish that with the qualified plan and Social Securities. But as your income gets higher, it's harder and harder to do so. So at 150,000, yes, we do have a gap, but you can see that that gap expands. So up to the max where we have 300,000 of salary, that gap is bigger. And that leaves everybody to have to save outside of the workplace. And it's very difficult to eliminate that gap with just outside savings. So the non-qualified plan can really help to severely minimize or eliminate that gap by offering the opportunity for them to contribute more. And it's because of the tax efficiency of the non-qualified plan that allows them to be able to have a better chance to eliminate that gap and get closer or meet that 80 or 85% level. And really, it's all about that tax compounding, right? The power of tax deferral. So here we have a combination of participation in a non-qualified deferred compensation plan versus the outside brokerage account. So we have the same statistics of a level annual contribution of $20,000, a static interest rate all years of 7%, contributions for the same amount of years, et cetera. So, but you have the taxes impacted with the brokerage account that you don't have with the non-qualified plan. So that account balance is always going to be bigger. You know, and even after it, so for example, that 877,000 number, even if you took a lump sum and paid taxes on it, that number is still going to be bigger than that 477,000. So you're really offering the opportunity for tax efficient savings by offering them the opportunity to defer income in addition to the non-qualified plan. And I'll take it one step further by talking about distributions from the plans. So you look here and you see these numbers under lump sum distribution that carry over from the prior slide. 596,000 is the net lump sum, that 877 number, and then the 477. So we have 25% more wealth coming out of the non-qualified plan. But look, if I elect as a plan participant to take distributions over a period of time instead of electing a lump sum distribution. If I elect to take a 15-year distribution schedule from my non-qualified plan, I end up with 45% more wealth based on the same static assumptions than under the brokerage account. So there's really an opportunity for a company to really be efficient in how they are allowing their employees to be able to accumulate just by offering them salary deferral, salary and bonus deferral, and allowing them to get closer to retiring, you know, when they want to retire. These next two slides I like to refer to where the magic is and how we design a non-qualified plan to really align with corporate objectives and goals. So for example, if we're looking at recruiting, sometimes just by offering the opportunity to save more money is an essential benefit to help them recruit. Hey, in addition to the qualified plan, you can save tax efficiently in the non-qualified plan. And we usually see salary and bonus there. For public companies, we'll see restricted stock units also, but allowing that salary and bonus to be deferred tax efficiently, you know, helps them manage and mitigate their taxes today and allows them to accumulate tax deferred. If we're looking at rewarding, we're looking at company money, right? A select group participating in the plan using corporate contributions on an annual basis. So what we see today is a lot of performance-based contributions where we're looking at maybe a metric, right? So maybe it's EBITDA of an organization, maybe it's overall profit. So we're looking at a metric that the company is focusing on, and you're saying to the participants, if we do well, you do well. You're sharing in the growth and participating because you're helping us drive the future of the organization. And rewarding is also a great way for companies that are privately based to use as an alternate or a substitute for key employees that might want equity in the business. So for private companies, I find that stakeholders aren't always interested in giving equity, but synthetic equity and designing a non-qualified plan so the participants are benefited as if they had equity is also a nice alternative for them, where they are participating in growth. Just a little food for thought. We also see using company money for 401k restoration. You're either limited to what you should be getting as a contribution in the qualified plan, we'll make it up in the non-qualified plan, right, for that select group of participants. And of course, we could just do something discretionary, percentage of compensation or whatever we feel like doing this year. But there's, you can either be super strategic in how you want to align company money, or you can just be, we're going to leave it discretionary. And if there's company money, we're always trying to put some glue in the seat. So we're looking at vesting, right? So vesting, you have a lot more flexibility with a non-qualified plan than you do with a qualified retirement plan. So, we always have conversations. My thing is I always say, you just want a vesting schedule where a plan participant feels that they will eventually receive the benefit. So 0 to age 65 isn't, usually my favorite, vesting schedule, but we do have flexibility with how we design it. When we're working with clients to design a new plan or to even refresh a plan that they've had that maybe isn't working as well for them, this is where the magic is and where we live. So we're looking at who is participating in the plan. And again, back to our earlier conversation of who qualifies. I always like to see a census, and we're talking about and looking at a few things: compensation, job description or title rather, job grade, how are we basing who is who's going to participate in the plan? And it's usually not one. We might look at VP and above, and the compensation is not one I like to focus on alone generally, just because, again, of geographical issues. So so usually we're looking at what is their title, what is their role, and, what is their compensation level. And we'd like to see a little bit of a break between the highly compensated and not. Contributions, if we're looking at corporate contribution design, that's really where the magic is. Do we want it to be performance driven? What's the budget? How do we want to design that to align with the company and meet their goals and support their compensation philosophy, right? And the vesting. So we can look at vesting, and it could be, again, a cliff, 0 for 5 years. It could be a rolling vesting schedule, meaning that a contribution next year is a pro rata vesting, 1/3 over 3 years or 1/4 over 4 years. And the reason for that is you're vesting in something, but you're always leaving something on the table should you leave. So, or it could be something completely different, 0 for 3 years and then 20% a year. So we have great flexibility, and it's what industry are we in, how tightly do we need to put the glue in the seat, et cetera. So I think that's kind of where the magic is with every company when we're talking about how do we design this to make it really work for you that are putting in the plan for your plan participants. From an investment menu perspective, a plan does have an offering, just like a 401k, there will be an investment lineup. We do see for income deferral plans, it is common sometimes to just mirror the same lineup in the 401k. But I do get clients that say, I want an executive menu where, the executive group, we want something a little more edgy or maybe something a little bit more different. So there might be some crossover, but not identical. So we have flexibility with what we do for the investments. If we're mirroring, we might have some target date risk funds. If we're not, we might have some risk model portfolios. Are you aggressive to make it easy? Are you conservative? Here's what your lineup would look like. So we do have flexibility with that. Distributions. Usually lump sum is always an opportunity for a distribution. I want to get my money out. And we usually have at least 1, maybe 2, depending on the size of the plan, of periodic installments, right? So what I like to see is 10 years as an option. And the reason is if I'm an employee in California and I think I might retire to Nevada when I stop working because of the tax situation, then I want to elect my distributions to be paid out over 10 years. And the reason for that is when I move to Nevada and start taking my non-qualified plan distributions, California cannot tax them. If I elect to take it as a lump sum, California can tax them. So we call that the source tax law, source tax rule. And the way it works is if you're taking it out 10 years or more, then that state that you're in that might have a state income tax cannot tax those benefits. So it's something that we talk about during enrollment and make people aware of if they're living in certain states like New York or California and might want to move to Florida where I am, or Nevada if you're on the West Coast, et cetera. The other thing for distributions that is super popular with non-qualified plans is what we call in-service distributions. And this is the feature that allows participants to elect distributions while they're still working. No penalties. Yes, it's taxable when you receive it, but you can accumulate to a certain point in time. So let's say, for example, Susie is going to be 18 and starting college in 10 years. I could elect to defer for 10 years and then elect to take distributions out over for 4 years to offset college tuition fees. So it might be for college tuition. It might be, I think I'm going to buy a second home, or I'm going to take a sabbatical, whatever the financial reason is that a participant might want access early, they can elect to have access early to their vested account balance. And they can also have flexibility to redefer it as they got closer to it and decided they didn't need it. So let's say Susie joined a biker gang and was not going to college. So then I could keep the money in the plan and redefer it. So there's some rules around that, but it's easily doable. And it's something
And
that, yeah.
Can I jump in here for a point of clarification?
Mhm.
I'm sure when we talk about the possibility of reducing taxes, people's ears peak up. And I know that you are not a tax advisor or an accountant, but when you talked about the periodic distributions, is there any magic to the number 10 for installments? Like if you were paid out periodic installments over 3 or 5 years, and let's say you moved from California to Nevada, would you be able to avoid the California state income tax there?
No, you do need the 10 years. I think if you're not worried about the source tax law, I would go for as long as possible based on the fact that you can maintain the compounding. But if we're looking at the source tax, then it's going to be I would elect for the 10-year distribution. Great question.
Thank you.
Yeah, so wildly popular, the in-service distributions. Most plans offer them today. If you have a plan at your organization and it doesn't, we can, do a simple amendment and certainly add that feature, but highly utilized within the non-qualified plan world. We do have benefit security. I'm going to push that off because I have a few slides on that towards the end, but there are things to think about benefit security because non-qualified plans are different than a qualified retirement plan. They have some similar features, but they are different. And I'm going to push funding off a little bit till I get to a few slides further in the presentation also. This is a comparison of the non-qual versus the qualified retirement plan. So I think this is a great summary slide to talk about how do they differ because they do have similarities. I always like to say that on the front side, it's like very similar to the K plan, pre-tax deferral, gross tax deferred, benefits are taxable, but that's really where the similarities differ. With a non-qualified plan, there are no limits. I could contribute 100% of my compensation if I am offered to participate in a non-qualified plan. We usually will have a plan document say that you can only put in about 80%, but that is not a legislative requirement. That is usually just a practical requirement so the company can have some cash on hand to pay payroll taxes. But legislatively, somebody could defer 100% of their compensation into a non-qualified plan. They have the investment lineup similar to the qualified plan. Where the differences kick in is hardship. Both plans do offer hardship distributions, and it is a little bit different. But here's the short story. We just went through 2 horrible hurricanes on the East Coast. If we had plan participants that suffered a hardship and needed money, they could get it. With a non-qualified plan, this plan sponsor, the company, does need to bless it and say, yes, this is a hardship, you can do it. So the rules are a little different, but the short answer is yes, it is available at hardship. Another difference is the deferral election is irrevocable for a non-qualified plan. So right now, 4th quarter is the busy enrollment time. Everybody is enrolling in the 4th quarter for electing what percentage of their compensation they want to defer for the upcoming year, effective January 1st. So if I'm participating in a plan with Raymond James and I elect 10% of my salary and bonus, well, that is an irrevocable. So unlike the qualified plan where I could change mine all the time, you're not changing the non-qual. So you do have to choose wisely when you're deciding how much do I want to defer into the non-qual. Loans are not available under a non-qualified plan like they are with a qualified retirement plan. There are no rollovers when you separate from service, so you are going to receive it as you elected to receive it distribution-wise, and it's a taxable event. There are no minimum distributions from a non-qualified plan. There's no fees. We talked about in-service distributions. There's no fees. You have elected and you can receive your money if you signed up to do that, right? So I think a big difference here is the plan balances are secured from claims of creditors in the event of companies' insolvency and bankruptcy. It is protected under a qualified retirement plan. Plan balances are not protected in a non-qualified deferred compensation plan. Now, there's a lot of things we can do, but to protect against that, we are not able to do that. And that is what gives it all its fabulous tax features, is you are subject to a risk. The company goes belly up, odds are you may not receive your plan balance. Now, when we look at court history of companies in bankruptcies, usually when it's voluntary money, I decided I wanted to defer a percentage of my compensation. Usually they will set that aside and provide that back to plan participants. It's generally the company money that can be lost in the event of insolvency, because as a plan participant, you are an unsecured creditor. Really what a non-qualified plan is, a promise to pay something in the future. I'm electing not to receive my compensation today, and you're going to pay me in the future. It's a promise. So that is a risk. I've never had a non-qual plan not be implemented because of this risk, but it does require education, right? And usually the company is setting assets aside. So, but there is a risk there. And of course, prior court history is not any guarantee of future court history, but that's what we've seen to date with any bankruptcies, et cetera. So some similarities, some differences.
Christine, that's such an important point. And that actually, there was a question that was asked about 10 minutes ago, and I was waiting for this time I knew that you would address it. And part of the question was, what information should we be sharing with employees? What if the organization declares bankruptcy? Will they lose anything? So what I'm hearing from you is that there's a greater risk if it's employer money versus employees deferring. I'm sure you'll talk to it in a minute, that there are ways to earmark assets in a trust, so that maybe that helps with the case. And another question just popped up about organizational insolvency. So that really does speak to whether or not the plan is funded or unfunded, whether there are assets in fact to cover this promise. So there's a number of decisions at the organizational level when it comes to plan design. And Christine and I were joking, 'tis the season to talk about non-qualified plans as we were prepping for this organization, for this presentation. Just yesterday, I hosted an educational session for a non-qualified plan client, and it was speaking to the executives. They're making a change and an enhancement to the plan design. And what we're looking to do is not only educate about this plan specifically, we're going to get to it, but how does this plan fit into their total rewards package, right? I personally have on my list of things to do before the end of the month, I have to enroll in my deferred comp plan. So it's, the seasonality of this is because you have to make decisions in advance of actual receipt of income in 2025. So that's an important point. Before we go to the next slide, there is a question that I also think it was applicable to address here, because it relates to 401k versus non-qualified plans. And the question was if highly compensated employees can participate in both. And of course they can. The key here is that sometimes, depending on how 401k enrollment looks and participation, highly compensated employees may be restricted in how much they can contribute to a 401k, perhaps because of some plan testing constraints. So you may have have a situation where you have to limit the amount that highly compensated employees put into a qualified 401k plan. And if that is the case, there are solutions that you can work with your retirement plan advisor and vendors to vet, which could include, going safe harbor for a 401k if you have plan testing issues. But oftentimes that's something that is expensive. Maybe it's prohibitively expensive. So if you're still looking to allow your employees, your executives, your highly compensated employees to optimize their deferrals, then it's perhaps offering a non-qualified plan is a nice supplement to an organization where 401ks run into some plan testing challenges. So I think
Great topic. Yeah, and shame on us for not making that clear, but yes. So absolutely both. But I would say this, usually when I'm having a conversation with a client about non-qualified plan, it is because there's a problem with a qualified retirement plan. So it's either, as you alluded to, right? They're limited, they're struggling, contribution refunds, or it's I'm having a challenge with recruiting, with keeping people. We're having a lot of turnover. My key people are leaving because there's better offerings somewhere else. So those are the topics that start let's look into this and then, proceed forward. Does this work for us to solve our, the pain point that we're having?
Christine, before we go to the next slide, I do have another question that just came through on this point. It's kind of a technical one, but if the plan sponsor is a subsidiary of a parent organization, would the parent company be required to make true on promises made by that subsidiary in the case of bankruptcy?
So it depends. It really kind of depends
on how you say that.
Drafted. Yeah, it depends on how everything is drafted. And if sometimes yes, but it could be no. So I can't give you like a blanket yes or no on that, but that's also a great question. All right. So Kristen.
Oh boy, this is one of my favorite slides, I will tell you, and I've used it in a lot of different capacity. But if there was a subheading to the strategic retirement readiness, it's through the lens of total rewards. And when I think about, how do you optimize your benefits? If I'm the employee, there's a lot of decisions employees have to make. And I think there's a perception in many organizations that, oh, my benefits aren't good. Well, you know what? Maybe people don't understand or appreciate the magnitude of the benefits they have because we're talking to employees in silos. We talk to them about the 401k when we have an enrollment meeting. We talk to them about the HSA when it's time for open enrollment. After tax 401k, that's relatively new. I'll talk about that. And then non-qualified plans, we talk to in November and December. So I like to introduce both to employers and employees this concept of, where should my next dollar go if I'm looking to save? And there is this hierarchy of savings. You could make some generalities that, if you're not participating in the 401k and not deferring enough to maximize the employer match, even if you're eligible for a non-qualified plan, that may not be the right place for you to put your next dollar. So it's really important to appreciate that while these are four separate talking points here, headings, so to speak, about benefits, what we really as HR, as finance, what our challenge is to communicate and work and educate employees about how they work together. So with the pre-tax 401k, we have, as Christine has said a number of times, there's IRS limits on the amount that you can contribute. What's interesting for 2025, thanks to Secure 2.0, which was an act passed a couple of years ago, you've probably seen some correspondence through your 401k vendors or consultants on this, is that effective 1/1/25, you have the ability to offer an enhanced catch-up if for employees between the ages of 60 and 63. Why they stopped at 63, I don't know. It's a head scratcher, but that's the way the rule is written. So that's an additional education point for employees and may impact whether or not they're deferring in the non-qual plan. Okay, well, if I can have an additional nearly $3,000-4,000 in 401k savings, I think I want to do that first. So it's important to talk to these things together. The HSA, we've done sessions just on health savings accounts. From my perspective, this is a lost opportunity. And I promise I'm not going to spend so much time on this, even though I often sit on a soapbox, because if you use those plans efficiently, it has the option of being triple tax exempt, meaning you put in tax advantaged, it grows tax advantage, and if you take it out for qualifying medical expenses, it's not taxed. But of course, because there's all these benefits, the IRS puts a pretty low maximum in terms of the amount that you can contribute. The after-tax 401k, that's relatively new as well in terms of, it's been around for a long time in terms of a money source, but the utilization, you actually have the ability to convert after-tax 401k dollars into Roth dollars, which is interesting for those employees who are looking to stash away more money, and perhaps they're making too much money to make a traditional Roth IRA contribution. So the word Roth, you're going to hear more and more. This is the means through which Secure 2.0 was paid for. And I promise I'm not going to get too much into legislative detail here. But the way that Roth dollars work is that you're making an after-tax contribution, and that grows tax exempt. So in 2026, so fast forward, figure 14 months from now, all catch-up contributions for those who make over $145,000 need to be made to a qualified plan through a Roth. It was supposed to be effective a year ago, but there was no way that the industry or plan sponsors were operationally prepared to execute this requirement. So what that does is it limits how much your Highleys can defer in the 401k. So if you're reading between the lines, what do I see here? I see a non-qual plan opportunity, right? Because maybe you can bridge that gap and offer continued, if not increased, ability to have tax deferred savings, which is where we get to the non-qualified plan column here. It's customizable, the ability to grow your assets. And it's interesting from a distribution strategy perspective. How often, if we're just talking about your employer-sponsored savings plan through the lens of retirement, you're losing some of your employees because retirement is not the only goal. So, and what did I mention before? Employees are looking to us as employers to help them with their total financial picture, not just retirement savings. And that's something that's unique in the non-qual space because you can have those in-service distributions and save for goals. Retirement's an important one, and I wouldn't want to cannibalize your retirement savings to fund, shorter intermediate term goals, but it's nice to have flexibility.
Yeah, I think also too, if I could just add, I think when we are working with clients and we're going through the enrollment cycle with the participants in the non-qualified plan, we're, as she said, we're taking a wider lens and looking at everything. We always, in my history, I've always tried to encourage, do what you can in the qualified plan first and then utilize, the non-qual when you're looking at these, but you do have design capability or offering capability, I should say, because of that feature coming out with all catch-up going to Roth. So the non-qual could help them, but it also helps them not only in accumulation, but distribution strategy. How do I look at these in terms of distributing from my personal financial situation? And we're able to kind of help them with some insight there, like usually during the enrollment calls, talking about this of how should I elect my distributions, what should I contribute, et cetera. So there's a lot that goes into the value add that we try to offer when we're going through that process during enrollment season with participants.
Yes, and the idea of using the non-qualified plan as a bridge, you could bridge yourself to the age in which you might maximize Social Security benefits. So the idea of using non-qualified plan assets to give yourself an income stream, a pension, so to speak, in retirement before you're ready to take Social Security, because we know if you delay until at age 70 at this point, beyond your full retirement age, you can increase your Social Security benefit by 8% a year. Okay, well, that's real dollars. But you have this problem, which is maybe you're not working and you need to give yourself income to live. So using the non-qualified plans to bridge that gap. Also, perhaps you don't want to hit your 401k or your IRA until your required minimum distributions, until you're that age. using the non-qualified plan to give you a continued paycheck after your final day at work has both financial benefits, but also mental benefits. Like they're from a just a plan management behavioral finance perspective. We like to get money coming in. So if you can fund that during your working years so that you feel comfortable, certainly within the earlier years that you're retiring, that installment distribution strategy that Christine walked us through may be beneficial.
All right, we have talked about plan design and what it can offer. I'm going to get into the nuts and bolts and talk about the behind the scenes. How does this really actually work? So when we get through design and we decide we're going to offer a non-qualified plan, that creates a liability for the company, for the sponsoring organization. You are promising to pay something in the future, as I mentioned. So that equates to a liability, and that liability goes on the company's financials, because we have a plan that's going to have annual contributions, regardless of whether it's employee, corporate, or both. There is an annual contribution going in. It's getting tracked by notional hypothetical accounts. So we're looking at the investment lineup, and the third-party administrator is tracking that daily based on the performance of those accounts. And so this is the side of the plan. The left side is the plan, and the plan creates a liability. And now we go to the right side, and the right side is, we talk about benefit security, which I'm going to defer for another slide or two. How do we protect those assets from a couple of things? What can we protect it against and not protect it against? And actual investments, because the non-qualified plan is not required to be funded. A non-qualified plan is a promise to pay, and it is not required to have any funding at all. And in fact, it cannot be what we call formally funded, but 401k is formally funded. It's in an ERISA protected trust, right? The non-qualified plan will lose all of its great tax features if we formally fund the plan. So the company has a promise to pay. Account balances are tracked as if there were money invested in those investments. It's a notional tracking. And the company can choose to fund or not fund. Now, generally, they will fund. You might see a large public company like Apple not fund because their financials are publicly available. Any participant in the plan could look online and look at their balance sheet from the last quarter, et cetera, et cetera. They would look and say, well, we can earn more on our cash, but everybody else is going to fund. You see public companies that finance their liabilities. You see private companies especially 100% of the time will finance their liability, but they're not required to finance it. So that's all, the understanding, but they will, because participants like to know there's money accumulating to pay out their benefits. That's really the main reason. So I think another distinction here with financing non-qualified plans, or just the plan in general, is with a 401k plan, a company receives a deduction when they make a contribution to the 401k. With the non-qualified plan, the company receives the deduction when they pay the benefit, not when they make the contribution, but when they make the benefit payment is when they get the deduction. So the deductions may not be a little bit ways down the road. So the in-service distributions, the retirement distributions, that's when the deductions come about for the company. When we look at surveys, consistently, I would say about 70% of the market will finance their plan in some way, right? So like I mentioned, you might have some of the larger companies do what we call as pay as you go. We're not going to set any assets aside, and we're going to pray we have the cash flow to pay these out when the benefit emerges and becomes due, right? That's the minority. And the other reason it's the minority is, except for the larger organizations, it's the most expensive way to go about having a non-qualified plan. It is definitely more efficient for a company to set assets aside today. So deferrals are $1 million a year. I'm going to invest $1 million in some asset and have it grow. So the choices generally come down to corporate taxable securities, where the company owns the asset. It's an asset on their balance sheet. It is not tied directly to the plan, even though it is accumulating to pay out the benefit under the plan, or what we call corporate owned life insurance. And that's the tax managed asset. And the reason companies like corporate owned life insurance is for tax efficiency. It too will accumulate tax deferred on the balance sheet. It will allow for tax-free distributions if you're structuring it properly. And it also provides key person coverage because tax-free death benefits will flow in. So for those tax reasons, you will see that the majority of companies will evaluate and generally lean towards corporate-owned life insurance for financing. Now, what we typically do is go through an evaluation and have a conversation about both and say which one does, and walk through what makes more sense for every organization. Taxable securities are understandable, right? Oh, I'm going to invest in the same, mutual funds, et cetera. However, right, every year there's a corporate tax gain. Every time you reallocate that portfolio, it's a tax friction. When I'm selling or, for distributions, it's tax friction. So for those reasons, the tax managed is generally a little bit more favorable, but it's an evaluation that we go through with every organization to walk down and say, what does make more sense, right? This is like a good, I think, comparison. They're both, you're going to have fund choices, very similar fund choices. And it doesn't matter if we're going back to mirroring the 401k or if we're doing an executive menu. They're both simple to implement. When we're utilizing corporate-owned life insurance, the company is purchasing insurance on their key participants, maybe some of them, maybe all of them, depending on the size of the plan. The employee executive participants are consenting to be insured. They don't have any rights to the insurance. It's key person coverage. And we're using that as an asset to drive on the balance sheet and accumulate tax deferred. And consenting to be insured doesn't impact any of their personal financial planning issues or anything like that. It's just a corporate efficiency tool that they're utilizing to drive to be able to have a pot cash to pay out benefits down the road. And it comes down to which makes more sense. And sometimes one does, sometimes a hybrid does, sometimes the other does. So it's something that we're looking at and having an educated conversation about, usually with a benefit committee, a retirement committee, or yada, yada, something along those lines. But it's something that, it's important, right? Because we're going to drive the financing of the plan. In the absence of time, I'm just going to move on. I want to talk about benefit security because this is very important. When you are a participant in a non-qualified plan, you are subject to all of these, right? A company is sponsoring a non-qualified plan. They could have a change of heart any day. They could just, I have an asset that I'm setting aside, but I decide I want to use it for something else. Maybe we're going to purchase real estate. Maybe we're going to buy a company. Maybe I need more inventory, et cetera, right? There is it because the asset is a corporate asset. They could utilize it for whatever they want and stop utilizing it for earmarking it for the plan. Change in financial condition. Maybe they've had a downturn. They're not really able to make those contributions for the plan. A change in control. We live in an M&A world. So maybe, they're being acquired, and certainly there's never a penalty. A plan could be terminated any time, but a change in control. What happens to my benefits that I'm vested in, right? Well, if we terminated it, we would pay out vested benefits, but what happens if they keep it? Do they freeze it? Do they keep utilizing it? What happens in bankruptcy? So we said before, the bankruptcy, the financial insolvency, there is no way to protect against that. We can set assets aside, and often companies do, but there is no way to really formally protect. And that's what allows us those great tax features of offering and participating in a plan. But the other three we can protect against, and we use what we call a rabbi trust. It's called a rabbi trust because the first time a trust was used, it did happen to be for a rabbi. A temple was sponsoring a deferred compensation plan for its rabbi, but it is an irrevocable trust. They're pretty common, and the drafting of them is pretty similar. It's kind of standardized today, but it's an irrevocable trust. So it is an asset of the company. It's still on, the assets, whether it's investments, whether it's insurance. It is on the company's financials as an asset, but it protects the plan participants in the event of a change of control, a change of a heart, or change of financial condition. So it is really protecting the participants. The money in there is only used to pay out plan benefits. So it is owned as if it were directly on the balance sheet, but it's a layer of protection for plan participants, but not for insolvency. You always remain an unsecured creditor if you're a participant in a non-qualified plan, but we can protect against the other issues for benefit security. A plan does require administrative services, just like a K plan. Non-qual plans do require, we know them all, and we can suggest depending on the complexity or lack of complexity for a plan. So a super complex plan might need white glove service for plan administration. A different plan type that's not super complex might only need, not all that white glove service, and they don't want to pay for it. But they all have online enrollment. Participants can log on, a call center, all of the administrative services that you would expect with a K plan are available for the client in terms of reporting, which is probably more than the K plan, and for the participant. Implementation timeline. I bring this up because I think this is a great insight. Here it says about 8 weeks. I would say 8 to 12 weeks. Normally, once we say, hey, we're going to go move forward with a plan, we will have weekly timeline, implementation calls with the third-party administrator. Let's kind of get it moving. So before we get to this, we're usually looking at a couple of meetings with human resources, a retirement, a benefit committee, et cetera, to kind of get a general idea of what are we going to do with plan. Client can get an idea of what are we looking at for budgetary purposes, what does the plan look like for my financials, et cetera. What direction might we want to lean in for financing? So we're kind of looking at all that, but during the implementation, we can kind of wrap it all up and finalize it. I look at this and say, if I'm putting in a new plan, then this is, once we get, yes, we're going to do this, this is what we're looking at, 8 to 12 weeks. I also look at this and say, okay, if that Roth catch-up thing, if I wanted to offer that for 1/1/26 and offer the opportunity for them to defer pre-tax as an alternative to their catch-ups being forced Roth, then I would say you sort of want to know by July, August next summer that you're getting into the schedule to enroll for fourth quarter. You can put a plan in any time of the year. Plans generally tend to be calendar year, so we could have a short year 1 year and then move on to a full calendar year. So it could start anytime. But this is how I would look at this, is if there was something I wanted to put in for 1/1/2026, I would want to know by August, we're moving forward with this.
Yeah, and you know what? I would even argue like August in a typical year, yes. But for all the reasons you described, Christine, I would anticipate tremendous demand for a 1/1/26 start date. So we've got to factor in like vendor capacity. So getting on their schedule, it would be important. So, I mean, now's a great time, honestly. Here we are, it's 13 months before some of the Secure 2.0 provisions that are going into effect in 26. Use 2025 as a planning year. And the 8 to 12 week time period that Christine mentioned, that's for implementation. There really is a prerequisite timeline that goes into strategy and coordination with your other benefits and identifying and communicating, okay, well, who's the target audience for this type of plan? What's our budget? Do we want to contribute? Do we want to start by just offering executives the ability to defer more income? And then we could see how that goes and layer in employer contribution perhaps at a later date. So there's certainly a lot of things to talk about. Here we are. I can't even believe we've been talking for 58 minutes, Christine, and it seems like there's so much more that we could possibly cover. What I would say in terms of follow-up and next steps, we are going to be sending out the slides. We do offer, when we talk about 401k plans, the ability that Raymond James can offer to help you benchmark a plan. That's in the qualified plan space where there's a lot of public information. In the non-qualified plan space, really, it's a conversation about what are your organizational goals and objectives, and maybe it's getting proposals from vendors to see, what are the ways that we can structure your plan to not only, minimize your costs, but also optimize the employee and executive experience. I've seen and I've worked with our clients to not just talk about non-qualified deferred comp, but really talking about executive financial planning and how does this tool fit into that overall benefit. So there's a lot to think about. There's coordination with HR, with finance. I see here another couple questions. We have 1 minute. Someone's asking about the recording, yes, we are certainly, that takes that's a process. We'll have to have it go through compliance, but I'll certainly, we can share that. There was a question about the differences in the taxes that an employee pays with a non-qual plan and a 401k before and at distribution. Christine, could you talk to that for a minute?
Contributions are pre-tax, so they are not, so they will pay FICA for employee deferrals if I'm deferring my own money. So you are subject to FICA, but you skip the federal and state taxation, and then you are subject to income taxes at distribution. If you have employer contributions, FICA is due as you vest on that. So, and oftentimes you're above that limit, so sometimes it's moot, but yeah, but it's the same. It's just, it's that income taxation that you are escaping.
Well said. We are at the top of the next hour. So thank you everyone for your attention, for your engaging questions, and for joining us today. There is an opportunity. I'm sure if you're leaving here with more questions, please feel free to reach out individually and we can continue the conversation. Wish you all a very happy holiday season, happy Thanksgiving. It's a time of gratitude. We're hoping that we can help you get your employees to have some gratitude for the great benefits that you and your team offer. So take care.